Welcome back to Investing Talk Podcast, everyone. Today, we're going to be looking at DaVita, ticker symbol DVA, a company that's been making waves in the dialysis market. You might have seen the headlines. Their stock took a pretty dramatic plunge on February 14th, dropping over 11% to close at $157.42.
Yeah, what's interesting is that this drop happened despite DaVita exceeding expectations for their fourth quarter 2024 earnings. They reported adjusted earnings per share of $2.24, along with revenue of $3.3 billion. Both figures beat the analyst estimates.
So they're posting strong numbers, yet the market reacts negatively. Clearly, something else is at play here.
Exactly. The market is forward-looking, and investors are focused on what DaVita's projections suggest about their future. And those projections, particularly for 2025 earnings, seem to be the root of the problem.
Their guidance for 2025 did fall short of expectations, didn't it?
Yes, DaVita projected earnings per share between $10.20 to $11.30. While seemingly decent, this range fell below the analyst consensus estimate of $11.24.
So even a slight miss can spook investors, especially when it comes to future earnings.
That's right, and this wasn't the only thing making investors nervous. We also saw Berkshire Hathaway, ticker symbols BRKA and BRKB, led by Warren Buffett, reduce its stake in DaVita.
Now, that's a move that definitely catches your attention. Buffett's known for his long-term investment approach, so any adjustment to his holdings sends ripples through the market.
Absolutely. Berkshire Hathaway reduced its DVA stake by over 200,000 shares. It's worth noting that they still hold a sizable 45% ownership, but the timing of the sale right after the earnings report raised eyebrows.
It almost makes you wonder if Buffett is seeing something that the broader market might be missing.
It's impossible to say for sure, but it certainly adds another layer of intrigue to the DaVita story. Now, beyond the earnings guidance and Buffett's move, there's another significant factor weighing on the company, their debt load.
DaVita's debt has been a topic of discussion for a while now.
Back in 2020, they had $15 billion in debt against a market cap of $7.5 billion. This translates to a debt-to-equity ratio of 2.0.
For those of us watching from the sidelines, how should we interpret that ratio? What does it tell us about DaVita's financial health?
Essentially, a high debt-to-equity ratio indicates that DaVita relies heavily on borrowed money to fund its operations. While debt can be a tool for growth, a high ratio like this increases risk, particularly in a rising interest rate environment. Higher interest rates mean more expensive debt payments, which can eat into profits.
So it's like having a mortgage with a variable interest rate. When those rates go up, your monthly payments increase, putting a strain on your budget.
That's a good analogy. And that's exactly what worries investors. High debt coupled with potentially lower earnings in 2025 creates a lot of uncertainty about DaVita's ability to manage its financial obligations.
And as if the debt wasn't enough, DaVita's also facing challenges specific to the dialysis industry itself.
Yes, there are a couple of headwinds to consider. First, there are reports suggesting Medicare might be looking to tighten reimbursements for dialysis companies. This could directly impact DaVita's profitability.
Reduced reimbursements would mean less revenue coming in, further complicating their ability to manage that large debt.
Precisely. Additionally, we can't ignore the lingering effects of the COVID-19 pandemic. We've seen this across healthcare, and the dialysis sector isn't immune. Treatment delays during the pandemic and the subsequent rise in wage costs are still putting pressure on companies like DaVita.
So we have a mix of internal challenges, like the debt and the 2025 guidance. Combined with these external industry pressures, it's a lot for any company to handle.
It certainly creates a complex landscape for DaVita to navigate. Now, to understand where the company might be headed, I think it's helpful to take a closer look at their business model itself. How do they generate revenue and what drives their profitability?
That's a great point. DaVita is a major player in the dialysis services industry. But what does that actually entail? Could you break down their business model for our listeners?
Of course. At its core, DaVita provides dialysis treatment to patients with end-stage renal disease, meaning kidney failure. Dialysis is a life-sustaining treatment, filtering waste products from the blood when the kidneys can no longer do so effectively.
So they're providing an absolutely essential healthcare service to a vulnerable population.
Exactly. DaVita generates revenue primarily through two avenues. First, they operate a vast network of dialysis clinics, both across the U.S. and internationally. Patients visit these clinics for their regularly scheduled treatments, which forms their main revenue stream.
It's almost like a subscription model for healthcare, ensuring consistent revenue.
That's a very apt comparison. Their second revenue source stems from what we could call ancillary businesses. These include providing lab services, pharmaceuticals, and other products related to dialysis treatment.
So they've created a vertically integrated model, participating in multiple stages of the patient's care journey.
Precisely. This diversification can be a strength, helping to buffer them against fluctuations in any single area of their business. However, like any company, they face challenges. We've already touched on some of the major ones. Their debt load, potential Medicare reimbursement changes, and the ongoing effects of the pandemic.
Right. But let's delve a little deeper into those industry-specific challenges. What are some other factors that could impact DaVita's profitability moving forward?
One key factor is the competitive landscape. DaVita essentially operates in a near duopoly with Fresenius Medical Care, a German-based company. This limited competition in the dialysis market can be advantageous for pricing power.
But could this lack of competition also attract attention from regulators? Concerns about potential cost implications for patients and a lack of market diversity could lead to increased scrutiny.
That's a valid concern when a few companies dominate an industry. Especially in healthcare where affordability and accessibility are paramount, there's always a risk of increased regulatory scrutiny.
And of course, we can't forget about the rapid pace of technological advancements. The healthcare industry is constantly evolving with new treatments and technologies emerging all the time. Could this disrupt DaVita's business model?
Absolutely. There's ongoing research into unofficial implantable kidneys and other innovations that could potentially reduce or even eliminate the need for traditional dialysis.
So for DaVita to thrive in the long term, staying ahead of the curve in research and development is crucial.
Yes, they need to be proactive investing in R&D and potentially partnering with innovators in the field to adapt and remain competitive. Now, while we've been discussing DaVita's financials, their business model, and the competitive landscape, there's another crucial aspect we need to consider, the long-term outlook for the dialysis market itself.
That's a great point. What trends should investors be paying attention to in terms of the future demand for dialysis services?
Well, one significant factor is the aging population. As people live longer, the incidence of age-related illnesses, including kidney disease, is expected to rise. This suggests a growing need for dialysis services in the coming years.
So the demand side of the equation seems relatively secure, even with potential technological disruptions on the horizon.
Yes, the aging population trend points towards continued and potentially increasing demand for dialysis. However, this also ties back to the issue of affordability and access.
Right. As the demand for dialysis grows, ensuring equitable access and affordability will become even more crucial. This puts a spotlight on factors like insurance coverage, government healthcare policies, and the overall cost of treatment.
Exactly. These are complex issues with no easy solutions, but they're critical considerations for investors who are evaluating the long-term prospects of a company like DaVita.
It's a reminder that investing isn't just about analyzing financial statements and projecting earnings growth. It's also about understanding the broader context, the social and political factors that can shape an industry's future. It definitely highlights the interconnectedness of business and the broader societal landscape. So with all these factors in play, what potential scenarios could we see unfold for DaVita in the coming months and years?
Well, let's start with the potential upside scenario. If DaVita can effectively address these challenges, perhaps by renegotiating debt terms, finding ways to mitigate the impact of potential Medicare reimbursement cuts, and successfully managing those rising costs, we could see a rebound in their stock price.
And as we discussed earlier, the demand for dialysis services is projected to grow. If DaVita can maintain its market position and capitalize on that expanding demand, their long-term prospects could be quite positive.
Exactly. They're operating in a sector with inherent growth potential, and if they play their cards right, they could emerge stronger from this period of uncertainty. However, we also need to consider the potential downside. What happens if these challenges escalate?
What would a less optimistic scenario look like for DaVita?
Well, if their debt becomes unmanageable, Medicare reimbursements are significantly reduced, and those new technologies disrupt their business model. DaVita could face some very difficult choices.
A scenario like that could erode investor confidence, leading to further decline to their stock price.
It's certainly a risk. DaVita's management needs to demonstrate a clear and proactive approach to address these concerns and communicate their strategy effectively to investors. Transparency and decisive action will be key to regaining market trust.
So we've outlined the potential for both upside and downside. What are some key indicators investors should monitor to gauge which direction DaVita is heading?
First and foremost, keep a close eye on their debt management. Are they taking steps to reduce their leverage, perhaps through refinancing or other strategies? Are they finding ways to reduce their overall debt burden?
And of course, any updates on those potential Medicare reimbursement changes would be crucial. Is DaVita actively engaging in discussions and lobbying efforts to protect their interests and ensure a sustainable reimbursement structure?
Absolutely. And then there's the question of innovation. Are they investing in research and development? Are they forming strategic partnerships with companies working on cutting-edge technologies in the dialysis field? Their approach to innovation will signal a lot about their long-term vision.
And let's not forget their core operations. Are they expanding their network of clinics strategically? Are they implementing new technologies or processes within their existing clinics to enhance efficiency and ultimately improve patient care? These day-to-day operational decisions will be telling.
All excellent points. Investors should also closely scrutinize DaVita's earnings reports and guidance statements. These releases offer valuable insights into their financial performance and their outlook for the future. Pay attention to not just what they say, but also how they say it. Are they confident and transparent, or are they hedging and vague?
It seems like DaVita's story is far from over. They're at a crossroads facing both substantial challenges and potentially rewarding opportunities. It'll be fascinating to see how they navigate this complex landscape in the months and years ahead.
For investors, DaVita presents a compelling case study. It demands thorough analysis, a balanced perspective, and a willingness to stay informed about the evolving dynamics of both the healthcare sector and the broader economic environment. This is a company that requires active and informed monitoring.
All right, it's been another insightful discussion about the intricacies of the market. Thanks for joining us on Investing Talk Podcast. Don't forget to subscribe to our channel to stay up to date on our latest episodes, and we encourage you to share this episode with your fellow investors. We appreciate your listenership and always welcome your comments and feedback.
Until next time, keep an eye on those market trends, and remember that informed investing is the key to navigating these turbulent times.
We'll see you on our next deep dive into the world of investing.